Let's take a look at our final priority as it relates to money that we allocate in retirement. We've already looked at liquidity. That's simply making sure we have enough money set aside for upcoming short-term goals and emergencies. We've already looked at covering the income gaps that our predictable income sources don't cover. We finally, just before this video, looked at growth and the continued need for growth because of rising costs in retirement. Now, if we just met those three priorities only, we would be in fairly good financial shape, but we would still leave the risks of premature death and the loss of income that comes from that, or a long-term care event, or unexpected health care costs that we didn't anticipate. We leave ourselves open to those risks, which really could undo everything that we've set up before in regard to our priorities of liquidity, income, and growth. Because if we have a substantial loss of income due to one spouse passing away, we've kind of wrecked the whole predictable or guaranteed income. If we incur significant costs for a long-term care event and we have additional expenses that we didn't anticipate, then once again, our predictable income versus what our actual expenses are break down. The amount that we need to cover the future growth of income, in addition to unanticipated expenses, also breaks down. So the last column here, when I think of protection, or I say protection, I'm looking at pure risk issues. I'm not looking at protection of your investments from loss. That we covered in the growth column. We talked about ways to mitigate loss and different ways to help protect the dollars that we put in the growth column. Protection column, we're really talking about pure risk, those events that come up that are generally able to be covered by an insurance company. So the goal is to mitigate these big catastrophic losses, things that are going to completely derail us from achieving our financial goals. So what's the positive when we put money here? Well, obviously it's to protect us from these losses. We're in a position, if we get the proper protection and we put the proper tools in place, that none of these issues that come up are going to derail us. But we've got to give something up, as is the case with every single priority. If we use one tool in particular, we're going to gain something, we're going to lose something. So in the area of insurance protection, it's kind of one of the most unsexy uses of money, because ultimately we're getting a level of coverage from these catastrophic losses, but there's no real tangible benefit or feeling other than peace of mind. I could have used these dollars somewhere else. I could have used it for liquidity, which kind of has this tangible benefit where you can see money in the bank. I could have used it to create income, which really has this tangible benefit of covering your retirement costs. Or I could have used it for future growth, and you can obviously see over the years a growing account balance being a tangible benefit. But if I'm covering a loss of income or long-term care expenses as examples, I get the coverage, but I don't really feel like I have a tangible benefit. So there's this opportunity cost where I could have used these dollars somewhere else. So that you have this tension between how much do I need to cover and how much am I willing to give up or lose the opportunity cost of these dollars in order to have this level of protection. So when we do our ultimate planning, if we're able to either carve out a certain amount of our assets to cover these, or sometimes coverage doesn't come from assets but could come out of our cash flow. So it might be an income need that we have. We need additional income in order to cover, let's say, insurance premiums, Medicare as an example, long-term care insurance as an example, life insurance premiums, all examples of ways, all examples of insurance needs or risk protection mechanisms. So sometimes I'm going to cover it through my cash flow. I'm going to pay ongoing premiums, but there's also ways to set aside a portion of our assets, a lump sum of our assets, in order to cover costs, and we'll talk about those in future videos. So, kind of summing up of these 4 priorities that we have, we've got a priority to have liquidity and availability for funds. We've got the priority to cover all of our gaps in income that aren't covered through Social Security or pension or other guaranteed sources. We have the goal of growth to keep up with increasing costs and inflation. And we've got the goal to protect from catastrophic losses in the event that we lose income or end up with additional catastrophic higher expenses that we didn't anticipate.